November 2024. America has made its choice, and the markets prepare to respond. Donald Trump is back to the White House, bringing a significant shift, not only in politics, but in economic priorities. This presidency will reshape the landscape of American finance, and investors are paying close attention. But what should investors expect? How might Trump's policies shape the stock market? And could we see history repeat itself? To understand how Trump's policies may impact your holdings, we need to look back at history. In 2016, markets reacted optimistically to Trump's election. The Dow Jones surged past 19,000 points for the first time in history just days after the victory, ending the year with a gain of over 11%. His first term showed us how his policies could impact specific sectors: financials, industrials, and energy. But what about this time? The economic climate is radically different. Inflation is high, the federal deficit has doubled, and stock prices are already on their peak. Meanwhile, the S&P 500 trades at a high valuation, with the price-to-earnings ratio approaching 22, far higher than in 2016, when it was closer to 16.5. Unlike 2016, this market is under pressure, making it sensitive to any policy shifts. Trump's return comes with promises of aggressive economic changes. Once again, he plans to cut corporate taxes, this time from 21% to 15%. In theory, this could boost company profits, leading to more hiring, investment, and growth. The markets may initially respond positively, especially in areas like energy, defense, and finance. But with inflation already running hot, these tax cuts could quickly add fuel to an already heated economy. During Trump's first term, the Russell 2000 index surged by 30% in his first year alone, driven by small, domestically focused companies. Why is that? Because they are less vulnerable to global trade policies and benefit more directly from Trump's tax cuts. Financial experts suggest that small cap stocks might be set for a growth under Trump's policies. But small caps come with their own risks. These companies often lack the stability of larger corporations to withstand economic downturns. With inflation running high and interest rates likely to rise, their operating costs could increase, putting pressure on profits. Investors interested in small caps will need to watch the Federal Reserve's actions closely, as rate hikes could significantly impact their profitability. How will the stock market respond to these pressures? Let's take a closer look with a sector-by-sector breakdown. Financials. Banks and financial institutions stand to benefit from Trump's policies. The perspective of lower taxes means higher profitability, while a rising interest rate environment raises their margins. As bond yields climb, banks gain the advantage of charging more on loans while keeping savings rates relatively low. But there's an issue. As inflation rises, the Federal Reserve may be forced to keep interest rates high. This is beneficial for financials in the short term. But as borrowing costs increase across the economy, high interest rates could hold overall economic growth. For banks, this creates a delicate balance. The higher their interest rates, the more they profit, but also the greater the risk of defaults as consumers and businesses struggle under the weight of higher debt costs. Technology. The tech sector is in the unique position. On one hand, tax cuts could free up cash for tech giants, enabling more innovation and capital investment. However, Trump's view on trade could spell trouble for companies relying heavily on global supply chains. For giants like Apple, tariffs on imported components may cut into profit margins, forcing them to raise prices or live through additional costs. Trump's opposition to tech regulations could open doors for further growth, particularly in areas like artificial intelligence, data storage, and cloud computing. But the question remains, will these benefits be enough to offset the rising costs associated with tariffs? Investors may need to consider carefully which tech stocks are set to withstand this storm. Energy. The energy sector is set to thrive under policies favoring fossil fuel expansion. Oil and gas companies may benefit from regulations, increased drilling, and reduced environmental restrictions. For short to medium-term gains, investors may look to established oil producers and refiners. However, the global shift toward renewables is inevitable. A diversified approach, with a moderate allocation to renewables mixed with traditional energy, could capture gains while avoiding risks if green energy policies re-emerge in the future. Industrials and manufacturing. Industrials and defense stocks hold significant promise under Trump's push for investment. For investors, companies with minimal reliance on global supply chains and a focus on U.S. infrastructure projects are likely to perform well. Trump's America First policies favor domestic production, incentivizing companies to keep operations within U.S. borders. This sector may rally, especially as Trump pushes forward with plans to lower regulations and expand infrastructure projects. But at the same time, tariffs are a double-edged sword. Trump has hinted at renewed tariffs on imports from countries like China and even U.S. allies. While these policies could temporarily protect American industries, they also risk starting trade wars and driving up production costs. For manufacturers, tariffs mean higher prices for raw materials. In the short term, investors may see industrial stocks rally, but the resulting volatility and rising costs could ultimately temper these gains. So, how do you stay profitable in 2024? Trump's first term showed us how his policies could impact specific sectors. Financials, industrials, energy, all surge with the promise of deregulation and tax cuts. But 2024 brings new challenges. To maintain profitability in 2024, investors should consider focusing on sectors with high domestic exposure, diversify with a mix of traditional energy and renewables, and favor well-capitalized banks and U.S.-focused industrials. In this new chapter, profitable investing may depend on more than just picking the right sectors. It will require patience, a sober mind, and a commitment to adjusting strategies as market sentiment evolves. For those who stay informed and adapt to the times, Trump's presidency could bring both opportunities and potential challenges.